Welcome back, everybody. Chris Jameson here with SF Lending, your hard money lender for life. Now we're going to jump into Hard Money 202, getting pre-qualified. So first off, reference Hard Money 105. That was where to find hard money. That's going to refresh your memory on finding referrals, talking to people at RIA groups, meetup groups, looking at Propelio website, things like that, to understand where to find the hard money lenders before you get pre-qualified. And one important thing is you really need to understand your hard money lender's specialty. What I mean by that is, do they specialize in flip loans in high value areas like Frisco or Alamo Heights or different areas in different cities? Do they specialize in working with portfolio lenders to get you refinanced out of the properties? Do they work with conventional lenders to help you get the best rate and term if you qualify for conventional loans? Do they specialize in short-term loans like 3 months or transactional funding? Or are they 12-month term, things like that? What do they specialize in, and what is their AO, a military term for area of operations? Are they based out of Houston and say they operate in Dallas but don't really have boots on the ground or anyone there to really be your local experience? Are they based out of Houston and say that they loan in Dallas but don't have a local representative there to give you boots on the ground knowledge? Do they say that they work in these other markets, the outskirts, the secondary markets, tertiary markets, places like Kemp or Corsicana or different areas around the outskirts of major cities? And you also need to understand the loan structure. There's a lot of very, very complex structures that hard money lenders can have, and there's ones that are very, very, very simple and easy to understand. So ask questions like, do they loan up to a certain percentage of ARV? Is it 65%? Is it 70%? 75%? Is it something like the lesser of the purchase price or the rehab or the ARV or LTV? You really want to understand that, you really want to make sure that you understand your lender's capabilities and if they match up with your expectations. You also want to understand your lender's loan terms and fees. What I mean by that is, do they offer maybe 12% money in 2 points, but it's a 3-month loan or a 6-month loan, and they're going to hit you with extension points until you bleed to death? Or do they give you peace of mind and have a 12-month term, knowing that they're going to work with you through the loan process to make sure that you get in and get out of hard money? You want to understand if they charge interest on escrowed funds. What I mean by this is, if they're charging 12% or 14% or 10%, whatever the rate is, are they charging you on your unused rehab funds that are held in escrow? This can be a phantom cost of somewhere between $200 to $1,000 a month that you don't know that you're paying unless you ask. Roughly, the difference between a 12% lender charging on escrowed funds and a 14% lender not charging on escrowed funds, the break-even point is about a $25,000 rehab. So if you have the liquidity to float the rehab, you'd actually be saving money if you used a lender that was a little bit more expensive on rate that didn't charge on escrowed funds. How do you qualify for hard money? Go back and take a look at Hard Money 107. That's going to be very important for you to determine your exit strategy, helping you figure out what you're going to do up front and get your ducks in a row before you start pursuing and looking for deals. So you want to be able to know if you qualify for rentals, if you have to go to a portfolio lender or a local bank or a national institutional lender, or if you can get conventional financing, get 10 Fannie Mae, Freddie Mac loans in your name, and then go on to the other steps. Or if you're flipping the property, how many properties can you flip at once? What's your liquidity? What's your experience level? You really want to make sure you understand what your defined exit strategies are up front before getting into hard money loans. The hard money loan application is going to be pretty simple. A lot of lenders use a 1003 application, which is just the standard Fannie Mae, Freddie Mac mortgage application. You can have other forms that are found online or sent through email. A lot of things are done electronically these days, or you can even get something PDF version or file out PDF version or fill something out in person. Most lenders are going to run a credit report. This is something they want to do to verify if you have any outstanding collections or liens or things, just to make sure that there's nothing that can affect their ability to get their money back if you're selling the property or refinancing. There's any kind of state, local, or federal liens against you. That's the primary reason why a lot of people run. That's the primary reason why a lot of lenders run credit. Most lenders are still mostly asset-based. They're not necessarily qualifying you based on credit, but they want to see what's in the credit. Do you have a history of a bunch of late mortgage payments? Have you taken on a lot of debt recently? There's things that can raise red flags. So really it's just a baseline to figure out where you are at that point in time to make sure you're not taking on too much debt too quickly and that you're a good credit risk. The other major component of the hard money loan application is just sending in your bank statements. They want to make sure that you have the money that you say that you have. While they're going to trust you on your application for the amounts that you state that you have, they also have to verify these types of accounts. Some lenders will want to source different deposits and large amounts, withdrawals, debits, credits, things like that. Other lenders just want to see something on paper and look at the balance to see what the amount is that you have. Really, what the lender is looking to do is making sure that you can get out of the hard money loan before you get in it. Do you have enough money to account for closing costs, holding costs, selling costs? A lot of times things come up on inspection repairs when you're going to sell the property. Do you have a reserve set aside in case you have to replace a roof or a sewer line or AC or things like that? The hard money lender does not want to take properties back. Most don't. They want to be able to set you up for success, make sure you have adequate funds to get through a deal so you can come back and do business with them again and continue to do more deals, be more successful. It helps them, it helps you. The loan application is going to consist of your name, contact information, date of birth, social security number, things like that, so they can verify who you are, run credit. They're going to ask for financial information, what amounts do you have in the bank and checking, savings, what amounts do you have in retirement accounts, if applicable, investment accounts, stocks, brokerages, mutual funds, things like that. And also what kind of employment. Do you have cash flow coming in, like your personal cash flow statement? Do you have money coming in to be able to afford taking on multiple properties at once? Are you employed at all? If your exit strategy is to do conventional, to refinance and hold these properties for rentals, then do you have the ability to get out of the hard money loan into conventional financing or any other kind of bank or portfolio type loans? In that situation, the hard money lender is going to run things by a conventional lender or a bank or portfolio lender, making sure that you qualify with DTI, credit score, all the things that a traditional bank would require. They want to make sure, if that is your exit strategy, that you can qualify for that. If you have a property under contract, the lender is going to want to know about that right away. So get them the property address, the rehab, your estimated ARV, what you know about the property. Has title been open? Different things. Has survey been ordered? Go ahead and reach out to your hard money lender right away. Make sure that you inform them you've got a deal under contract, because you're going to jump ahead of the line on the pre-approval process if you have something tangible versus someone that's just shopping lenders and trying to figure out who they want to add to their team. A couple other things you might see are real estate investing experience. A lot of lenders want to know your experience. Have you done a deal before? Do you have 3 or 4 active properties out right now with different lenders? Do you have rental properties that you've successfully transferred out of hard money or purchased cash or straight conventional or straight bank portfolio type loans? Do you already have experience running rehabs and running managing tenants and things like that? They want to know your overall experience, how many deals that you've done and how many deals that you've done recently, because that can also lead to better rate and terms. Lastly, the declarations, authorization, and acknowledgement. Declarations are things like, have you filed bankruptcy, foreclosure, do you have any liens or judgments against you, things like that, just to make sure, again, that you're a safe credit risk. And the authorization acknowledgement is just, you are who you say you are, the facts in your application are true, and then you sign and date the application. For lenders that do pull credit reports, what they're looking at, they want to make sure that the credit report's no older than 90 days. They want to look at your median score, your tri-merge FICO mid score. That's going to be if you have a 700 credit, a 650 credit, and a 600 credit, they're going to use that middle number, 650, to get a base credit worthiness of you as a borrower. They're going to look at things like bankruptcies and judgments and collection accounts, foreclosures, mortgage payments, things like that, revolving accounts, just to make sure that you're handling finances well. because they're lending money to you. They want to make sure that you're handling their money well. Lastly, they want to make sure that the information that you put on the application matches what they pull in the credit, be it address, name, anything like that, the OFAC search, different things that could come up in the credit report. And lastly, state, federal liens. That's the number one thing lenders want to look out for in any kind of loan application with a borrower is, do they have state, federal liens? Because that federal lien is going to supersede their position on the mortgage. And if any proceeds were due to the IRS is going to get their money before the lender gets theirs back. Lastly, the supporting documents, like I mentioned before, just showing the investment accounts. Your checking, your saving, your money market, your 401ks, your stocks, bonds, mutual funds, things like that. They want to show your available liquidity. They want to be able to see your available liquidity and know if you have any additional funds. If things hit the fan, you've got the ability to tap into those other resources to be able to save the deal. If you're buying in an LLC, they want to make sure that you have a certificate of formation, certificate of filing, an EIN, organizational minutes, and a company agreement. A lot of people don't necessarily put that stuff together up front when they're forming an LLC. They don't do a company agreement and organizational minutes. You absolutely should and must if you're going to close any kind of real estate transaction. The title company is also going to require that kind of information, so you might as well do that up front. You're going to send that package to your lender, and you're going to send it to the title company when you're ready to close on a deal. The organizational minutes is what shows signing authority for the entity that you form. So if it's multi-member entity and you're buying on behalf of the LLC, but you don't have signing authority, that deal's not going to go through. You want to make sure that the person that has signing authority is putting everything together, because they're going to be the one that needs to sign on the loan and close through the title company. Lastly, some companies require tax returns, personal financial statements. They just want to see what you look like on paper, your experience, your personal cash flow statement, things like that. How well are you handling financing? What are your debt obligations from a broad picture? Photo ID, of course, verify who you are, and schedule of real estate owned, which would back the experience section in the application to prove to your lender your experience. The properties that you have, are they making money? Are they cash flowing? What's your debt on them? Do you own them free and clear? Different things like that. Your lender's just trying to get a broad picture of your overall experience as an investor. Thank you. That concludes Hard Money 202, Getting Pre-Qualified. If you have any questions, feel free to reach out, give me a call. Information's on the screen. Send me an email, cjameson@sflending.com. Thank you.